US tariffs top the agenda at this year's IMF-World Bank meetings. What are the key takeaways? Hello, I'm Arnold Naidoo, and this is The Heat. The IMF-World Bank meetings held in Washington, D.C. saw a number of economic leaders and delegations in attendance. This year's gathering was overshadowed by U.S. President Donald Trump's worldwide tariffs that has placed a strain on the global economy. CGTN's Owen Fairclough reports on the impact in Europe.
Donald Trump marking Victory in Europe Day during his first presidency at Washington, D.C.'s Second World War Memorial, a tribute to those who paid the ultimate price in a transatlantic alliance that was considered sacred, perhaps until now. But Trump's second presidency and the tariffs he's unleashed on Europe, whose member states include some of Washington's most steadfast allies, are raising urgent questions about the future of that relationship that was forged in a global war and has since been built on global trade. And delegates at the International Monetary Fund and World Bank's annual spring meetings are trying to address those questions. Namely, can these two sides forge a free trade deal in the current climate?
More trade is better, and therefore we are very encouraged that the European Union is continuing to move forward on trade agreements.
And yet the IMF's revisions to growth forecasts due almost exclusively to the projected impact of US and retaliatory tariffs have left European leaders at a crossroads, some calling for closer ties with China. And closer EU ties appear to be an aim for the UK's finance minister. At these meetings, primarily to try to forge a bilateral free trade deal with the US that was supposed to be the payoff for leaving the EU.
What we hear from the US administration is that they are keen to do a deal with the UK, reflecting the closeness of that relationship.
And yet Rachel Reeves later suggested EU trade ties are more important. As the European Union ponders the direction of its future trade alliances, it also has to contend with another huge financial challenge, spending more on the collective defense of Ukraine as the Trump administration steps back while managing increasing national debt levels. Owen Fairclough, CGTN, Washington.
To discuss this and more, let's bring in our guests. From Massachusetts, we're joined by Jorge Heine. He is a research professor at the Pardee School of Global Studies at Boston University and a former Chilean ambassador to China. From New York, we're joined by Anthony Chan. He is the former chief economist at JPMorgan Chase & Company. Thanks to both of you for joining us. Anthony, let me start with you. As I said, the big focus of this year's spring meetings, the IMF and World Bank meetings that have been taking place here in Washington, were the U.S. tariffs and its impact on the global economy. In fact, the IMF earlier this week released its Global Outlook report, which actually revised growth, global growth that is, for this year. Here is the IMF Managing Director, Kristalina Georgieva. Let's listen to her.
Among major economies, some countries like China need to act to boost private consumption and embrace a shift to services. Others, like the United States, need to reduce fiscal deficits, and in Europe, it is time to complete the single market, banking union, capital market union, removing internal barriers to intra-EU trade. Get it done.
Anthony, Georgieva also put the chances of a global recession at about 30%. What are your thoughts?
I think there is that risk, which is much greater than the normal 15% probability of recession at any given year. There's no question that tariffs do, in fact, raise the risk of slower economic growth, but they also raise the risk of higher inflation, which means it's a real challenge for policymakers on how to deal with that. The good news is that inflation in Europe is much lower than it is in the United States. And that's the reason why they've been able to consistently lower interest rates, while in the United States we're facing greater challenges. But slower growth is a way of life with when you have tariffs, and that's one of the reasons why the IMF lowered the economic growth prospects for the United States to 1.8% from 2.8% growth that we had last year. But don't forget, Anand, that for Europe, 65% of their trade is within the Eurozone or within the European countries. So they're vulnerable, but they're not as vulnerable as one might think.
Anthony, of course, as you point out, the tariffs will bring with it slower growth. But what about the White House argument that, yes, short-term pain, but long-term gain?
Well, that's certainly the argument that is being used, because there's going to be a lot of short-term pain. And if you don't say that, then it'll be very challenging for the people to acknowledge it or, in fact, even accept it. We, in fact, saw today that the University of Michigan is telling us that now, over the next 12 months, consumers are expecting inflation to rise to 6.5% year over year. And that is up from 5% last month. So that's a lot of pain. And 12 months from now, it's not even clear to me that's short-term pain. That seems to be medium-term pain and with no end in sight to this inflationary problem, unless somehow we bring that temperature down on the tariff situation.
Anthony, I spent a few days at the meetings here in Washington, just down the road at IMF and World Bank headquarters, and I spoke to a number of the delegates there. And one of the common sentiments I heard from these delegates was that they're now looking at alternative, more stable markets in the wake of these tariffs. And I'm wondering, to what extent, when you hear that from so many people, from so many countries around the world, to what extent is that going to presage some kind of reordering of world trade in the future?
Well, no, there's no doubt that that's already happening. You saw President Xi going to many of the countries in Asia, going to Vietnam and other countries, and talking to people in the Philippines or officials in other countries. So they're going to be moving in that direction, because to the extent that they can trade with each other without the big weight of these U.S. tariffs, they're going to do it. Europe already is talking about trading more within Europe and trading less with the United States. We, of course, are seeing that countries like Latin America are benefiting from this, because now, instead of buying agricultural products from the United States, China is buying more agricultural products from Brazil. So you are definitely going to see the reordering that you've just talked about happening over the next several months, or maybe even several years if this persists. And the issue is, it's already happening.
Ambassador Jorge Heine, what are your views on that? The fact that, these tariffs they'll cause pain in many places, but it could be advantageous to places like Anthony said, like Brazil, where China could go to that market rather than coming to the United States.
Yes, absolutely. Well, we already have an antecedent for that, of course. It happened during the first Trump administration, when that administration imposed tariffs on China. China retaliated by imposing tariffs on soybean exports and other products, and that immediately diverted quite a bit of trade to Brazil. And obviously projections are this is what will happen now. Again, I would emphasize that sort of the big takeaway I would draw from the meetings in Washington of the IMF and the World Bank is the great uncertainty that exists today over the world economy. And how a system that existed for 80 years is now being replaced by something else. We don't know what it will be, but it'll certainly be different from the one we have seen since 1944, when the Bretton Woods institutions were established.
And Ambassador, when you say uncertainty, what are the core concerns? Because a number of countries are already looking at alternative solutions to this. It could be, as we just pointed out, advantageous to some of those countries.
Well, no doubt it could be advantageous. But in terms of the United States, the fact that these tariffs have been established from one day to the next obviously generates a lot of uncertainty for many countries. They will have to make the decisions on how they can access markets in which there's more predictability and in which they know where they will stand. So the question to some degree is, some people are talking about what they say, the end of globalization as we have known it. I'm not sure that's the right approach. I think what we'll see is a different type of globalization, one in which the United States will not be at the hub of the system, but other countries will be. And that, it seems to me, is the basic reordering that Anthony was speaking earlier about.
Right. And Ambassador, if we look at some specific countries in Latin America, we take Argentina, for instance. The IMF has approved a $20 billion bailout for Argentina. In fact, the Associated Press said this is a welcome reprieve for President Milei. What impact will that have in Argentina?
Well, it certainly will help the government of President Milei, which is trying, as best it can to lift Argentina off its dire straits. I will say this, I hope that the same thing that happened with I think it was 45 or 50 billion dollars that the IMF lent to Argentina some years ago, and that sort of disappeared into thin air. We don't know where they went. I hope the same thing doesn't happen today. So the IMF has been very generous with Argentina. Let us hope this time the money is well used to strengthen the Argentine economy. We'll keep our fingers crossed, but there are no guarantees on that.
If we look at some of the countries that the IMF focused on in its report, we look at Mexico, and we were talking about Brazil. We look at Brazil as well. I mean, these are two of the largest economies in Latin America. Well, for Mexico, the IMF says they're expecting no growth. And in Brazil, the outlook was cut from 2.2% to 1.8%. As I said, these are big economies, so how much of a drag could they have on the other countries in the region?
Well, quite a bit. The last projections that I have seen is that Latin America will be the region with the lowest growth this year and the coming year from all regions in the world. So what we are seeing is that the region is unable to lift itself up by its bootstraps from the crisis that occurred in 2020 with the pandemic, when the region had its biggest downturn in 120 years. GDP in 2020 for Latin America fell by 6.6%, when the world economy contracted by only 3.3%. So we're having a real problem in not being able to get out of this economic slowdown. And that, it seems to me, is a real challenge. So in amidst of all these, the tariff wars and so on, Latin America must look for ways to get out of this rut. Hopefully, greater trade with China and with other Asian economies will be one way forward.
Okay, joining us now, joining the conversation from Oregon is Liang. She is Chair Professor of Economics at Willamette University. Liang, great to see you. We're talking about the spring meetings taking place right here in Washington at the IMF and the World Bank. And the big focus, of course, this week was on that global outlook report that was released by the IMF. China's economic growth was also revised downwards. A number of countries' growth rates were revised downwards, and so was China's, from 4.6% to 4%. What does that mean for China?
Well, good to be with you, Anand. So I think for China, their own growth target is set around 5% this year. And according to the IMF, the tariff will be a significant blow to China's economy. And they actually forecasted just because of tariff, it will knock down 1.3 percentage points of the Chinese GDP growth. But because the Chinese government is going to use fiscal stimulus, monetary easing, and other supportive policies, that's why they downgraded only by this 0.6 percentage points. But you are right. I think China still has a lot of toolkits, right? In the past 4 or 6 years, they have been trying to sort of tariff-proof its economy. It has been upgrading its trade competitiveness and built a lot of global trade partners, regional trade partners. They're also now trying to pivot towards more domestic demand, including consumption demand. So the Politburo meeting yesterday have reiterated that they're going to use fiscal policy using the current existing fiscal packages, rolled out more long-term special government bonds and also more special bonds at the local government level to stimulate consumption, especially as I mentioned about relending capabilities to improve consumer financing and also the care economy, the service economy. And so I think there are a lot of policy stimulus down the road in order to help to cushion the economy against these tariff war. And I would also add, though, that it seems that Donald Trump has really significantly, I think, rolled back or at least walked back in some of his rhetorics. And potentially, he's talking about substantially reduce the tariff. So I think it remains to be seen how long this sort of tariff standoff is going to last. And whatever that comes, I think China has made it clear that they will open for negotiation, but they will use their most energies and attention to try to cultivate the domestic market and really to sort of compete from a position of strength.
Right, and there were also reports in the media, in Reuters, there was one report which said that China will exclude some U.S. imports from its 125% tariffs in the hope of mitigating the economic fallout from this trade war. What can you tell us about that?
Well, I think it's clear that tariff produces only lose-lose situation. So retaliation, it's the same way. So I think in China's interest, they do want to examine some of the products. And when I look at the list, it's mostly semiconductor-related, pharmaceutical-related equipment and vaccines and things like that. That I think is sensible because tariff is essentially paid by the importing countries. Yeah. So if China does not want to suffer that loss, and if it cannot find alternatives in the very short term, I think it is in China's interest to be practical and examine some of these products. Same way Trump has already initiated all these exemptions on electronics and so on.
Anthony, looking at the outlook for the United States, the IMF downgraded U.S. growth for 2025 from 2.7% to 1.8%. How will that be received at the White House?
Well, I think we've already seen how it's received in the White House. They are calling for lower interest rates and basically lobbying Fed Chair Powell to lower interest rates. But in the wake of these higher inflation numbers and expectations, it's very, very challenging. I mean, there's really two schools of thought, because if you have a situation where the White House wants the Federal Reserve to do something, you can justify that by saying the president is elected by the people, the Fed chair is not. And even though I was a former economist at the Federal Reserve, I try to be open-minded. But on the other hand, there's a lot of academic studies, some even in prestigious journals like the American Economic Review, that show that when you have Federal Reserve independence or any central bank independence, those countries tend to suffer or experience lower inflation and lower inflation volatility. So you can make the arguments on both sides, but if you're worried about inflation, you got to have Federal Reserve independence. And right now, the White House wants less than Federal Reserve independence. They want the Federal Reserve to lower interest rates because of the fear that economic growth is slowing. But 1.8% is still not a recession. Yep. And with inflation rising, I think the Federal Reserve is still not going to lower interest rates at their next May 7th policy meeting.
Right, and Anthony, I want to get your view on something else, which I heard at the IMF meetings as well from some people, and that was these rumors that were running around, in fact, it's been going around for a few weeks now, that the U.S. might consider pulling out of the World Bank and the IMF. Well, that particular issue was addressed by the Treasury Secretary, Scott Bessent, and he sort of put them to rest. Let's listen to what he had to say.
America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
So, Anthony, do you think that might calm the waters a bit?
Yeah, I think it does. The same way that when the president said he had the power to fire the Federal Reserve chairman, and the financial markets panicked, and you saw the bond market, the value of the dollar, all markets showing instability. And then then of course the president said he had no intention of firing the Fed chairman. So yeah, the White House has recently thrown out these hand grenades and then walked them back. We have heard talk out there that somehow we didn't need these institutions, and now the Treasury Secretary giving us the importance of these institutions. So one thing we do know is that things change almost day to day and week to week. So, but for now, we are comforted by the fact that the president has no intention of firing the Fed chair, and we get some indication that the White House also has no intention of walking away from the IMF and the World Bank. But again, these things are subject to change.
Right, they are subject to change. Ambassador, you know, as Anthony says, they're subject to change. The Treasury Secretary, Scott Bessent, also accused the IMF of what he termed mission creep, and that it needs to go back to basics, needs to go back to what it was set up to do. Let's listen to some of that.
The IMF was once unwavering in its mission of promoting global monetary cooperation and financial stability. Now it devotes disproportionate time and resources to work on climate change, gender, and social issues. These issues are not the IMF's mission.
What do you make of that, Ambassador? I mean, is this some way of the United States calling for reform in these institutions?
Well, I wouldn't say it's calling for reform. What it is calling is for changing the agenda. And obviously, you know, it's very interesting because it doesn't only apply to the IMF, it also applies to the World Bank. The previous president of the World Bank that had been appointed by President Trump in his first term, Mr. David Malpassant, he had a skeptical view of climate change, and therefore he had to leave office under President Biden. And the current president of the World Bank, Mr. Banga, he has put climate change front and center, saying that 45% of the World Bank's loan will be assigned to climate change. But he is now changing his tune because he realizes that climate change is not very popular with the current administration. So he's speaking about nuclear power, speaking about gas as an alternative for generating electricity and power. So it's a very tricky issue how to change the agenda of the IMF and the World Bank. So we'll see how this plays out.
Liang, Bessent also accused China of, in his words, tilting away from consumption towards manufacturing. He said China's export-driven economy will create even more imbalances. This is sort of direct contradiction of what we've been hearing, haven't we?
Right. Well, so first of all, I think it makes sense for the United States not to withdraw from IMF or the World Bank. After all, these two institutions combined together, the United States contribution is about $210 billion in terms of the quota, the funds, and also the capital. So that, it's only about 0.7% of the U.S. GDP. And yet the U.S. is able to wield a very strong unparalleled power in these institutions. We know that IMF, the United States alone, right, has 16.49% of the voting share, which gives it the ultimate veto power. So the U.S. has a lot of power at these institutions, and I think they would not want to relinquish that kind of power, given the very small cost. Now, going back to Bessent's talk, I think, first of all, he thinks that IMF's main mandate is to ensure stability, right? Macroeconomic stability, balance of payment, and financial stability. But let's face it, I mean, with the climate change, with all the external climate shocks, if it's not being addressed, it's not going to be helpful for countries to maintain stability. It will not be possible for countries to achieve, sustainable long-term growth, which is what the World Bank is meant to do. Now, when it comes to China's comment, I also just wanted to get the facts right. China's manufacturing is powerful. It is accounting for, in terms of value added, over 30% of global manufacturing. But most of the manufactured products are still consumed at home. When you look at the gross exports versus the gross production of manufacturing, China pretty much consumes over 85% of its total manufacturing products at home. China's export dependency when it comes to export to GDP ratio, it's only 19.7%, which is much lower than the average of the world, which is around 29%. So I think it's not really the fact as he accused, China being imbalanced. I think the problem is, yes, China is a very large size economy. So when it exports some parts of its manufacturing, products, it does create competition. And I think this is what the United States cannot handle, which is that China is climbing up the value chain and become more competitive.
Yeah, and you were talking earlier on about China tariff-proofing its economy, this is something that started a long time ago, isn't it? I think we talked about this not so long ago, and you were telling us that the level of exports from China to the United States has been dropping, and it's been dropping for some time.
Right, exactly. So again, the U.S. Only now account for 14.6% of China's exports. And if you even add, China's indirect exposure to the U.S. through countries like Vietnam or Mexico, still all these means that the U.S. would account for, about 20% of China's total exports. Now, again, exports is also just a relatively small part of the total Chinese economy, especially when you look at the net export. The net surplus with the United States, it's only about 1.57% of GDP. So without the U.S., China can still trade with many other countries in the world. Its trade with BRI country has more than half of its total exports. So I think the U.S. is a very important, export destination, but still China is able to diversify. It is also have this vast domestic market. And I think it's time also for China to even pivot more towards domestic economy and, boost consumption growth to really enjoy, right, all the goods and services that its people produces.
Anthony, there was also an interesting comment that came from the IMF's chief economist, Pierre-Olivier Gorinsa. He said the global economy needs a clear, stable, and predictable environment. I mean, how does that square with the U.S. view that what the U.S. is doing here is simply leveling the playing field? The U.S. is, President Trump has told us this many times that the U.S. is getting ripped off in the world, that it's getting a raw deal. And here we have, the chief economist of the IMF saying, look, what we need is stability.
Well, I don't think any economist will argue with the fact that stability is a good thing. And when you continue to change your policies, tariffs on, tariffs off, and tariffs back on, that clearly creates instability. And that is never a very positive thing. And all you have to do is look at global financial markets, domestic markets in the United States or other markets around the world, and you can see that these markets are reflecting this instability. And for businesses, if you look at business uncertainty, whether you look at the National Federation of Independent Small Business, we have one of the highest levels of business uncertainty we've had in years. So clearly, we're not seeing any stable sort of messages coming out of Washington at this time.
Okay, and that's where we have to leave it. Thanks to all of you for being with us. That's it for this edition of The Heat. I'm Anand Naidu in Washington.